Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for June 28th, 2014. The market is in bullish quiet conditions. On an annual basis, using weekly RSI 14, it remains overbought. On a 10-day basis, using the 10-day NDX, we are also overbought at 84 out of 100. Price with respect to the 200-day moving average is white bullish at 8.26%, so we get a little over 6% cushion to sideways markets. The 5-day slope of the 50-day moving average is at 0.68. That's green bullish. That's strong. ADX 14 remains strongly trending upward at 26.6. ATR percentage quiet at 0.61. The risk index is the 30-period moving average of the VIX divided by the 10-period moving average. The threshold value is 1.0 for the boundary between risk on and risk off. It comes in at a score of 1.02, so we are in risk on conditions, meaning that riskier assets are favored to be held short term. If we then take that score of 1.02, compare it to the last 5,000 trading days, and find the standard deviation, we get the risk Z, which is at 0.17. You can see the 90-day time series of that indicator here, and after a period of extreme quiet, we pulled back to the zero line and are now starting to reverse and go north. That is consistent with this series of rising lows that we've seen in that indicator, which would suggest more quietude to come, favoring the XIV trade and the long side in the indexes. Monthly rebalancing will happen later next week on or about 1 July. These are the holdings from last month. These are the current leaders for these different portfolios based on the readings as of the close on Friday. The theoretical exposure in the ETF2 model is at 100%, and the model portfolio will be at 100%. It buys a position in biotech based on the Indonesian position stop was hit during the week and cash became available. Just a quick look at the ETF blended monthly rebalancing portfolios, the 13 with everything on a buy signal, and the 32 ETFs, also everything on a buy signal with the exception of agriculture. This is the ETF Max portfolio, again being dominated by everything India and Asia less Japan. Brazil remains very strong, as is the energy sector. And this is the S&P 500 seen through that blended monthly lens as well. This is the market health check. We have the vertical blue lines representing 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that were once resistance levels, which should continue to act as support, and if they fail, become price targets on the way down. The dark blue shaded area is the 30-period Bollinger Band plus or minus 1, the river. The lighter blue shaded area is the 30-period Bollinger Band plus or minus 2, that's the floodplain. The pink shaded region is the 10-period Bollinger Band plus or minus a half SD. We call that the dragon. That gives us early warning on changes in the direction of the river. You can see right now price is resting right on the outside shore of the river here on the north. The dragon is on that side as well inside the 10-period regression channel, and in the bottom half of the 30-period regression channel. This is still very favorable on the bullish side. Price will often ride that upper shore of the river on the way up. Price is in the green area, which is where I generally want to be long on the intraday trade, as long as it's above about 192.5 here, or the Bollinger Band mean. So at the first sign of strength intraday, I'm looking to go long. If price were in the yellow zone, I would be waiting to see the directional movement of the day before committing intraday. And then the red is where I would pick up the intraday bias of going short. You can see the 200 period moving average has almost fallen off the screen here. Bulls remain in charge, as you can see on ADX 14. The parabolic stop and reverse, these two dots at the top, are giving some early warning about a potential topping action in here. It's been almost 20 days now where we've been hovering at this 193. I take this as a sign of failure to fail further. We've had two efforts to pull the price back. Both were responded to with buying pressure. So I still think the upside is there, and a run at a price of 200 in the S&P would not be out of line. So we've had about 30 days now of upward pressure at the after having had about 60 days of sideways choppy action. You can see the percent price oscillator has opened slightly to the downside, so those last two pullbacks contribute to that weakening of the bull. However, this has been a pretty resilient bull, and absent any failure, you should be maintaining your long side bias. For me, that begins the first shift in my psychology would change at about 192.5 if it were to get back below the Bollinger Band mean. But meanwhile, looking for long and strong. The ETF2 regional report, all of the indexes are on a buy position or buy signal, which keeps the model again at 100% invested, 0% cash. The S&P at 62 is now pulled back in front of the Euro-Asia blend at 60. So right now the U.S. is favored. Inside the U.S., the leader is now technology, then large caps, then mid caps, then small caps. The two strongest sectors are emerging markets and Latin America, and the weakest sectors, U.S. small caps and mid caps. Inside the sector spiders for the U.S., the energy and utility sectors remain very strong, with consumer discretionary and financials very weak. The world market model, mixed strength in the U.S. with the small caps all weak, but real strength here between the U.S. Large caps and the SPY, and then in technology. Asia, less Japan above average, Japan below average. Strength leaders in the Asian countries, India, Thailand, Philippines. Canada remains very strong. Brazil has given back a little bit here, as has Latin America. Inside the business sector, slight tip of the hat to the U.S., otherwise pretty close across the board. The top 30 ETFs using the ETF2 methodology, again dominated by India and energy. Pharmaceuticals actually doing pretty well here. Those that are green and white or green and yellow or green and red based on strength and consistency deserve our attention. So the gold miner juniors are of interest for short-term momentum. Biotech is coming back into play. Infrastructure, silver miners, the biotech index itself, more gold miners, pharmaceuticals, semis, and Thailand. Among the Dow 30, leaders, Intel, Caterpillar, Cisco, Johnson & Johnson. Travelers, the laggards, the bottom five here you can see. Pfizer, IBM, JP Morgan, Visa, Walmart. American Express should be of interest in the financial sector. Financials are weak, but American Express starting to flex its muscles a little bit here with the white on the strength and yellow on consistency. And Goldman Sachs yellow on strength and red on consistency, so earlier in its stage of recovery. AT&T showing some strength. ExxonMobil and United Health also looking good. ETF liquidity, again, just showing the 30 most liquid ETFs based on the average daily dollar volume traded over the last 30 days, and their ATR percentage and how that volatility stacks up against other members in the ETF database. The ones in green being exceptionally good traders intraday because they're very liquid and also very volatile. We'll shift gears now to the daily report. No signals in channeling and overreaction. You can see that volatility may have bottomed a little bit here, and this accounts for that pullback in the risk index. This move in the risk index to pull back is a function of this slight increase in volatility here. But again, it could be getting quiet once more as we're seeing a little heads up of that reversal in the risk Z-score. Swing setups. Handful of channeling and overreactions among the Dow. We have European 350 with the channeling. XLP it should be of interest here with a 5DD and a triple screen, and 551 Ws with Latin America, Europe, industrials, Euro-Asia blend, and then the auto framer finding half a dozen signals that frame out well just on the basis of trade location. Some RSI2 signals in DuPont, ExxonMobil, and Travelers. So we're going to look at those three. ExxonMobil, DuPont, Travelers, Goldman Sachs, and Chevron. And you notice we've got quite a few nice frameable swing trades here. And then DuPont, ExxonMobil should be on our short list because of the auto framer reward to risk, along with Procter & Gamble and Goldman. Lots of frog quality numbers above 3, and that's very favorable. Among the ETFs, XLP should be of great interest. It's a 5DD, it's a triple screen, it's a 551W, it's 2.4 on the auto framer. So we'll take a look at XLP. And we're going to like Europe here with a 551W and a 2.6 to 1 on the auto framer. These are the stats on the auto framer here, as you can see. Good reward to risk ratios, and the initial risk that those ratios are built on upon a retest of the 10-day high. And then in the RLFF regression line fractal framework, we're going to take a look at some of these leaders. CVX, Intel, Coke, and Johnson & Johnson. We're going to look at those during the webinar tonight and look at them in detail. So enough on that right now. This nice little run-up starting to stall a little bit, as indicated by the polynomial regression line crossing the straight line regression, and you can see that the slope of the 30-period regression line has crossed its own 10-period 1 SD above the 6-month average, and so that's a cause to ensure that your stops are in place, that you're respecting your profits. You can see that that's been a little over a 2 SD move over the last 2 months, and that price is now right at the 6-month normal compared to the 200-day moving average. So we're right at the 0 line. Historically, we're a little above 1 SD above the 10-year normal slope on the slope of the 30-period regression line, and it's crossed its own 10-period like we just mentioned. So if we look back the last 10 years, that's only happened 1, 2, 3, 4, 5, 6, I'll call it 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 times, and were it to roll over here and come back below the 0 or below the 1 SD, that would be some cause for concern about reversion to the mean. That would get it certainly back 4 or 5% back towards the Bollinger Band mean on the river. So word to the wise there. On the z-scores for our regression line slopes, you can see the 30 has gotten extreme and is starting to roll over after a nice grinding upward move. The 10 has rolled over a little bit. It's gotten weak these last 10 days as we saw the two pullbacks, whereas the previous moves have been nothing but straight up. The 90, however, is still within that plus or minus 1 yellow zone of normal, although it's been strong, not exceptionally so. So there's still room for this to find support and go higher. But it is showing a little signs of hesitation here. And the reference charts just to complete the report. More to follow tonight in the webinar. So this is Ken Long from Tortoise Capital. Keep your powder dry and your risk measured.